Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Identifying common cognitive biases in financial decisions. Cognitive biases are systematic patterns of deviation from norm or rationality in judgment, and they often occur in ways that can significantly impact financial decisions. Understanding these biases is crucial for anyone involved in strategic investment, as they can lead to poor decision-making and suboptimal outcomes. This lesson delves into some of the most common cognitive biases that affect financial decisions, providing a comprehensive overview of their implications and how they can be mitigated. Anchoring bias is one of the most prevalent cognitive biases in the realm of financial decision-making. It occurs when individuals rely too heavily on the first piece of information they encounter when making decisions. For instance, when investors hear a company's initial stock price, they might use this as a reference point and fail to adequately adjust their valuation based on new information. Tversky and Kahneman demonstrated this phenomenon in their seminal work, showing how initial exposure to a number can unduly influence subsequent judgments and decisions. In the context of investments, anchoring can lead to the overvaluation or undervaluation of assets, as investors might cling to outdated or irrelevant benchmarks. Another significant bias is the overconfidence bias, where investors overestimate their knowledge, abilities, and the precision of their information. This bias can lead to excessive trading, as overconfident investors believe they can predict market movements better than they actually can. Barber and Odean found that overconfident traders tend to trade more frequently and, as a result, earn lower returns than their less confident counterparts. This behavior is also linked to the illusion of control, where investors believe they can control or influence outcomes that are inherently random. Overconfidence can thus lead to increased transaction costs and a failure to diversify adequately, both of which can detrimentally impact portfolio performance. The confirmation bias is another cognitive pitfall that investors need to be wary of. This bias occurs when individuals favor information that confirms their pre-existing beliefs or hypotheses, while disregarding or undervaluing information that contradicts them. Nickerson highlighted how confirmation bias can lead to the persistence of incorrect beliefs and poor decision-making. For investors, this might mean focusing on positive news about a favored stock and ignoring warning signs, leading to overly optimistic assessments and potential financial losses. The confirmation bias can also result in the selective gathering of information, where investors seek out sources that agree with their viewpoints, further entrenching their biases and leading to skewed investment strategies. Herd behavior is a common cognitive bias where individuals mimic the actions of a larger group, often disregarding their own analysis or information. This phenomenon is particularly prominent in financial markets, where the actions of a few can lead to widespread trends, sometimes resulting in asset bubbles or crashes. Shiller discussed how herd behavior contributed to the dot-com bubble, where investors followed the crowd in investing heavily in internet-based companies, inflating stock prices beyond reasonable valuations. Herd behavior can lead to significant mispricing in the market, as the collective actions of investors are driven more by social influences than by fundamental values. Loss aversion, a concept introduced by Kahneman and Tversky, describes how the pain of losses is felt more intensely than the pleasure of equivalent gains. This bias can lead to irrational financial behaviors, such as holding on to losing investments for too long in the hope of breaking even, rather than cutting losses and reallocating capital more efficiently. This behavior is often seen in the disposition effect, where investors are more likely to sell assets that have gained value while holding on to assets that have lost value. Sheffrin and Statman found that this effect can lead to suboptimal investment strategies and reduced overall returns, as investors fail to realize losses and miss out on potential gains from better performing assets. Another notable bias is the availability heuristic, where individuals assess the probability of an event based on how easily examples come to mind. This can lead to an overestimation of the likelihood of recent or memorable events and an underestimation of more statistically probable but less salient events. Tversky and Kahneman demonstrated how the availability heuristic could skew judgments and decisions. In financial markets, this might mean that investors overreact to recent news or market events, leading to increased volatility and potential mispricing of assets. For instance, a recent market crash might lead investors to overestimate the likelihood of another crash occurring soon, prompting overly conservative investment strategies. Lastly, the hindsight bias is the tendency to see events as having been predictable after they have already occurred. This bias can lead investors to overestimate their ability to predict future market movements based on past events. Fishoff illustrated how hindsight bias can distort our understanding of past events, leading to an inflated sense of foresight. In the context of investments, this can result in flawed strategic planning, as investors might believe they can predict market trends based on historical patterns, disregarding the complex and often unpredictable nature of financial markets. Understanding these cognitive biases is essential for making more rational and informed investment decisions. By recognizing the presence of these biases, investors can take steps to mitigate their effects. One approach is to implement systematic decision-making processes that rely on objective data and analysis rather than subjective judgment. For instance, using quantitative models and algorithms can help reduce the influence of cognitive biases by providing consistent and unbiased recommendations based on empirical data. Another strategy is to seek diverse perspectives and challenge one's assumptions regularly. Engaging with a broad range of viewpoints can help counteract confirmation bias and provide a more balanced view of potential investments. Additionally, setting predefined rules for buying and selling assets can help mitigate the effects of emotional biases such as loss aversion and overconfidence. For example, establishing strict stop-loss orders can ensure that losses are cut at a predetermined level, preventing the emotional attachment to losing investments. Education and awareness are also crucial in combating cognitive biases. By understanding the common biases that affect financial decision-making, investors can be more vigilant in recognizing and addressing these biases in their own behavior. Continuous learning and reflection on past investment decisions can help improve judgment and reduce the impact of cognitive biases over time. Moreover, leveraging technological tools such as financial planning software and robo-advisors can provide objective, data-driven insights that help counteract cognitive biases. These tools can offer personalized investment recommendations based on an individual's financial goals and risk tolerance, reducing the reliance on subjective judgment and emotional decision-making. In conclusion, cognitive biases play a significant role in financial decision-making, often leading to suboptimal outcomes. Anchoring, overconfidence, confirmation bias, herd behavior, loss aversion, the availability heuristic, and hindsight bias are some of the most common biases that investors need to be aware of. By understanding these biases and implementing strategies to mitigate their effects, investors can make more informed and rational decisions, ultimately improving their investment performance. Continuous education, objective decision-making processes, diverse perspectives, and technological tools are all valuable resources in the quest to master strategic investment and navigate the complex psychological landscape of financial markets. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.